Imagine a global financial stage where currency values dance to the tune of central bank whispers and economic data. Today, all eyes are fixed on Europe's inflation figures as foreign exchange markets simmer with quiet anticipation. But is this subdued calm a sign of stability, or just the eye of an unexpected storm? Let's dive in and unpack what's brewing in the Forex world on this Tuesday, December 2nd. A wave of wariness has settled over early European trading sessions, even as international bond markets seem to be finding their footing after yesterday's tumultuous sell-off, largely ignited by remarks from Bank of Japan, BOJ Governor Kazuo Ueda. For newcomers to Forex, think of central bank governors as the conductors of an orchestra, shaping the melody of interest rates and yields that influence global investments. In his address on Monday, Ueda hinted strongly at a potential interest rate increase come December, which propelled yields on global bonds, including those from Japan, to new heights. This ripple effect also buoyed U.S. Treasury bond yields, as investors pondered the upcoming decisions from the U.S. Federal Reserve Fed during their monetary policy meeting next week. It's a classic example of how one central bank's move can echo across oceans, affecting everything from stock markets to Forex pairs. Financial markets are currently betting heavily, an 87% probability, according to the CME Group's FedWatch tool, that the Fed will opt to trim interest rates by 25 basis points, BPS, by month's end. To clarify for those just starting out, basis points are tiny units of measurement in finance, where 1 BPS equals 0.01%. So a 25 BPS cut means reducing rates by 0.25%, potentially making borrowing cheaper and stimulating economic activity. Supporting this optimistic or dovish outlook was fresh data from the Institute for Supply Management, ISM, unveiled yesterday. The U.S. manufacturing sector shrank for 8 consecutive months in November, with the ISM Purchasing Managers Index, PMI, sliding to 48.2 from 48.7 the prior month, falling just short of the anticipated 48.6. For beginners, a PMI below 50 signals contraction, meaning businesses are scaling back production, which can hint at broader economic slowdowns. Yet, despite these lackluster U.S. figures, the U.S. dollar USD gained traction from the rising U.S. Treasury yields, maintaining its upward trajectory against key rivals. As I write this, the U.S. dollar index, DXY, is holding steady around 99.50, showcasing the greenback's resilience. But here's where it gets controversial. Could this USD strength be masking underlying vulnerabilities in the U.S. economy? Or is it a bullish signal for traders betting on American dominance? Many argue it's a temporary boost, while others see it as evidence of fiscal policy triumphs. What do you think? Share your take in the comments. To give you a clearer picture, here's a snapshot of today's US dollar performance against major currencies. USD EUR GBP JPY CAD AUD NZD CHF. USD minus 0.04%, minus 0.04%, 0.22% minus 0.04%, minus 0.20%, minus 0.02%, minus 0.10%. Year 0.04%, 0.01%, 0.27%, 0% minus 0.16%, 0.03%, minus 0.05%. GBP 0.04%, minus 0.01%, 0.25%, minus 0%, minus 0.19%, 0.03%, minus 0.06%. JPY minus 0.22%, minus 0.27%, minus 0.25%, minus 0.26%, minus 0.42%, minus 0.25%, minus 0.32%. CAD 0.04%, minus 0.01%, 0%, 0.26%, minus 0.16%, 0.02%, minus 0.06%. AUD 0.2%, 0.16%, 0.19%, 0.42%, 0.16%, 0.18%, 0.1%. NZD 0.02%, minus 0.03%, minus 0.03%, 0.25%, minus 0.02%, minus 0.18%, minus 0.08%. CHF 0.1%, 0.05%, 0.06%, 0.32%, 0.06%, minus 0.10%, 0.08%. This heat map illustrates the percentage shifts among major currencies, with the base currency listed on the left and the quote on the top. For instance, selecting USD as the base in JPY, as the quote shows how much the USD has strengthened against the Japanese yen. It's a handy tool for visualizing currency battles in real time. Shifting to the Asian session, Australia's Bureau of Statistics, ABS, reported a $500 million dip in the country's current account balance for the September quarter. Interestingly, this didn't drag down the Australian dollar to US dollar pair, which climbed 0.15% to 0.6555. Imagine the Australian dollar as a resilient surfer riding waves of global data, without getting knocked off its board. Meanwhile, US dollar to Japanese yen has rebounded towards 156.00, shaking off recent losses. A move that highlights the yen's ongoing softness amid Japan's monetary policy shifts. Euro to US dollar is hovering within a narrow band above 1.1600, with traders adopting a wait-and-see attitude ahead of Eurostat's upcoming November Harmonized Index of Consumer Prices, HICP inflation release. For those unfamiliar, HICP measures price changes across the Eurozone, acting as a key gauge for inflation pressures that could influence the European Central Bank's actions. Pound sterling to US dollar is clinging to 1.3200, moving sluggishly without major macroeconomic announcements from either the US or UK sides. It's like a calm before the storm, with potential for volatility once data drops. And this is the part most people miss. Gold, often seen as a safe haven asset, is steadying around $4,200 in European trading after some morning turbulence in Asia. XAU/USD, gold priced in USD, faces challenges from those elevated US Treasury yields and the USD's overall uptick. But could rising yields actually benefit gold in the long run by signaling economic strength? Or are they a headwind to its shine? It's a debate worth exploring. What's your view on gold's future amid these dynamics? In wrapping up, the Forex landscape today is a mix of caution, data-driven expectations, and subtle currency skirmishes. Do you agree that EU inflation data will be the game changer? Or is there a hidden factor we're overlooking? Drop your thoughts below and let's discuss. After all, markets thrive on differing opinions.